real estate is generally considered to be a very good long-term investment. With that said, the actual process of going out there and buying an actual investment property to manage is much more challenging than most investors realize. Fortunately, for that you have real estate investment trusts, which is a very efficient way for investors to gain access into the real estate market. My name is Sal Diaz, and today I'm going to talk about what REITs are, the advantages that they have, and the different type of REITs that are out there that can help you get exposure to very specific parts of the real estate market. Real estate investment trusts, also known as REITs, are public corporations that invest in, manage, and finance real estate investment properties. They're really like a mutual fund, except they invest solely in real estate, and they allow you to gain exposure to very particular sectors of the market, like hotels, office buildings, medical facilities, warehouses, data centers. What are the advantages of buying a REIT? First one, you get diversification. You are now buying a basket of investment properties as opposed to just one. Second, you get professional management. When you buy your own individual property to manage, that means you become a landlord and you have to now worry about taking care of your tenants. And that usually means finding plumbers during the weekend. With a REIT, you get the professional management from the corporation and they take care of all the day-to-day. Third, you get lower minimum investments. With just a few $100s, you can buy a share of a REIT, as opposed to the many thousands of dollars you will need to buy one single property on your own. Fourth, dividends. REITs have a history of paying attractive dividends. There's two different types of REITs. There's equity REITs and there's mortgage REITs. Equity REITs might be the ones that you're more familiar with. They tend to buy properties to rent, and from that rent, they get the dividends that they pay on usually a quarterly basis. The equity REITs tend to focus on particular sectors of the real estate market. That could be office space, or shopping centers, or medical facilities, or data centers, which allow you to pick what type of investment you want in real estate. Mortgage REITs are somewhat less familiar to most people. What they do is they buy and sell mortgages, and it is from the interest of those mortgages, which are loans, that they get the dividends that they pay the investors. So keep in mind that when you talk about a mortgage REIT, you're not actually buying the property. You're buying a loan which is backed up by that property. So whenever you're thinking about REITs, it's important that you decide whether you want equity REITs that are backed up by properties or mortgage REITs that are backed up by loans. And second, specifically when you're talking about equity REITs, think about which subsector of the real estate market you would like exposure to. Remember, real estate is extremely long in terms of the amount of options you can have. So you need to be very particular. In conclusion, REITs are an efficient way for an individual investor to gain exposure to the real estate market without requiring a large capital investment as a down payment or the actual time and effort that it goes into landlord.